She's the former CIO of a multi-billion-dollar Saudi family trust, and they know oil. Sarah Quinlan is now the CIO and founder of macro fund QAM. Good morning, Sarah.
Good morning.
Now, as the market is clamoring to bid Apple stock up to 700, as the VIX index or the fear index is hitting a low, you think we're ignoring big risk factors in the market. What are they?
Absolutely. There's three major risks that I'm seeing out there right now. First and foremost, obviously, oil prices. And secondly, Europe and the potential, significant extended recession there. And finally, China and the slowing there and the impact of the cascading effect of that.
Well, let's dig into oil. How do you really see it playing out here?
Well, I think the biggest problem is that it creates a fear in people. It creates a wariness to spend. And so it's not so much that I can't afford to go, fill up my car, et cetera, and do this. But when you think about, outside of New York where we don't really drive, the rest of the world really drives to get to their regular workday and this and that. So if they are spending on an ongoing basis a significant amount of money, and then you think about trucking and trucking goods places and things like that, this becomes an impediment to them actually continuing to spend. And we obviously know our economy continues to have a huge dependency on consumer spending.
When do you think we're going to see that shift? When are the markets going to say, wait a minute, these prices are unsustainable for us to just go on about our lives? I mean, in Europe, they seem to be more aware.
Well, as we know, we like to think that the market's efficient. I went to University of Chicago, but I like to add the word eventually. And the problem here is what is that, timing going to be? I actually think it's going to be later than we think. We have a couple of benefits. Obviously, the weather has been ridiculously warm, which has caused early, spending and higher spending than normal. So the consumer discretionary stocks, where I would initially see this, will actually have a sort of delayed response. But I would expect by the first quarter, when you start to see some earnings and some misses, that will be when the market starts to take a serious awareness. Should, of course, the oil market stay at the price or higher than it is right now.
But now you say oil trades the most on fear and greed. What do you mean by that?
Well, the interesting thing here is we know that there's supply. And in fact, Saudi came out and confirmed it yesterday. And in fact, from my sources, it's actually even higher than what they announced. They're sitting there saying they've got an extra 1 to 2 million barrels per day, that they easily could release into the market.
What do you really think it could be?
I actually think they could go up to 15 if they needed to, not forever, but they certainly could for a sustained period of 3 to 4 months actually release that much if they needed to shock the market down. So I'm not concerned in that regard. And I think the real issue we've got here, which are obviously bodes for the Keystone Pipeline, is really a distribution issue as opposed to so much not having the supply. In fact, there's, your earlier guest was talking about that North American supply will actually make up for what we're not seeing coming out of there. I'm not worried. As Naomi said yesterday, you close the Straits of Hormuz, I'll sell you the Egyptian pyramids. It's not going to happen. You've got 2 huge battleships right there to stop this happening.
So this isn't about, to you, geopolitical risk at all? Is
No.
that just a headline that people like to read, but it's not affecting the actual market?
Exactly. The market's just basically long oil in correlation. I mean, it's been trading in correlation with equities for a long period of time now. So I think that's really what's going on. But the biggest thing that you're seeing a decrease in demand. And, and I think Naomi pointed to this yesterday, and I absolutely believe this. If this demand will continue to drop, China is signaling this, as we discussed already, and things like that in Europe as well. One of the things, when oil hit $147 a gallon, and I was living in Europe, it cost me $220 to fill up my gas tank. It's not something that you do on a regular basis, and it definitely impacts your spending.
Let's talk Europe.
Exactly. And I take the moniker well. I think the interesting thing here in Europe is people, I think, are not aware how much it really is a state-run economy over there and how dependent everyone is on the states. For example, education is free. This has been a way to delay people coming into the workforce. Now there's no jobs. So even if they do stay in getting PhDs until they're 28, they still don't have any place to use it. That will completely derail consumption going on there. We saw today the deficit numbers coming out of Great Britain, 24 versus 13 as the estimate. Very, significantly higher problems due to austerity. So the fact is, I think it stops on a dime. I don't think it sort of gradually slows or they can find economic growth somewhere. They weren't having significant economic growth anyway. I also think you have real issues with the banks still with further write-downs. And the final thing, we all know that despite the LTRO, they're not lending. So businesses over there are starved. Okay, the publicly traded ones, no problem, go to the public markets. But that's not Europe. Europe's economy is run by small private businesses. And if they can't access capital, is something we've been talking about here, it's a real problem to economic growth.
So are investors blinded by LTRO or this ECB injection of funding into the market? Are they just ignoring the fundamentals that lie underneath?
Absolutely. I think they're absolutely underlying that we actually have seen a number of the economies tumble into recession already. We have evidence of this. And obviously that will really impact, especially the S&P 500, which Europe is a huge market for them. So I think this is one of the big issues that we have to think about. And let's not forget oil prices. As I mentioned earlier, this will be very impactful. They have very high oil taxes. So this will impact, again, their discretionary ability to spend.
Now, you run your own fund, but you also serve as a macro advisor to other funds.
Exactly.
How many investors do you speak to who agree with you fundamentally about Europe, but they're saying, guess what? I can't miss the rally. I'm playing anyway. Do you think there are a lot of false bulls actually playing?
I wish there were.
Bulls full of bull?
Yeah, exactly. I mean, I think the most interesting thing is if we look at the volume this year in the equity market, it's actually lower than the end of last year. And most of that, as we know, is electronic trading, which is very much volatile, in, out type of thing. So the fundamental person has actually missed the market. I believe a lot of the early part of the rally, frankly, was short covering. And now you are seeing certain people participating. I do think there's a melt up going on. We're going to see it again. The futures are indicating it again today. I think the follow through, as I said, the catalytic event probably is first quarter earnings and seeing who misses there. I think you're seeing a divergence finally where, the precious metals are not in, those types of things. And I think that will be more where some of these risks present themselves. But when you start to see, think about Ford has huge sales in Europe. That's impactful. GM's already warned.
Third biggest risk, China. Talk to me.
Exactly. One of the things is, it's the elephant in the room. We never know if their statistics are real or not. However, everything that I'm hearing in terms of the people I'm speaking with over there, it's absolutely real. And, we talk about building and voting for bridges to nowhere. They actually do it. And the problem here is you've got a lot of empty real estate. The difference was previously, they were able to sell their non-performing loans. They sold them to 6 companies, and large funds, such as Avenue Golden Tree, would go in, buy those at 10 cents, resell them at 40. This time, those loans are zero. There's not a bid for them. The Chinese government has to sop that up and continue to provide liquidity. They also sent a bad message this week by, babysitting the refiners by increasing gas for the second time in 6 weeks. A real negative for the market. And that will cascade through Southeast Asia.
Sarah Quinlan, I was planning on having a VIX party tonight. Fear index is at its lowest. For you, is it consensus? Is your fear that no one's actually paying attention to these individuals?
I think my fear is that you're a fiduciary. You absolutely have to think about the long-term returns that you've got. Why add the volatility? We know that we're only after 4 years, coming out of what we've been through before. Why take yourself down 37% again to have to dig out? So what I'm saying is add a little bit of protection. Think about some CDS, some long VIX to absolutely cushion what's happening. I'm not saying that everything is bad. We're seeing sales here and there, certain companies. Technology, obviously, there's continued demand for that. But I'm saying that overall, it would not hurt to have some protection for the difficult event.
Well, I am officially scared. So thank you to Sarah Quinlan. She's the founder of macro strategy fund QAM.